So welcome to the August property market update, with tensions going on between two massive superpowers, with a war going on and a conflict going on, economic headwinds. What does this mean for the property market and what has been going on in the property market? So this is that time of the month where I look through other influencers' pages, see what they're talking about, get my own information together and just have a little report on what's gone on last month in the property market. And at the end, make sure you stay around to the end because I'm going to give you my predictions and some actionable steps and advice on what you should be doing and couldn't be doing in this current climate. We're in definite uncertain times, but whenever there's uncertainty, whenever there's change, there is massive amounts of opportunity. So already now I'm going to tell you, just don't be sitting on your hands doing nothing. Make sure you prepare for this change and this opportunity that's presenting us. But let's get into this market update. Along the bottom, I know time sentence for some of you, so we're going to be talking about the rents. We're going to be talking, well, house prices first of all, rents. We're going to be talking a little bit about the world economics. And we're going to be covering interest rate rises. So really important thing for the property market. The conflict and what impact that's going to have, the conflicts going on in the world. And we're also going to give you my predictions and some actionable steps, what you can do at the end. So make sure you stay around to the end. One thing that you can do right now, right this second, is hit that like button. So if you've not done it already, subscribe as well, hit that bell icon so you get notified. Really helps the algorithms and I'm really grateful. But let's get into this month market update. So let's start off with RightMove. It's the biggest platform out there. Let's look at the data that they've gathered. They're saying in their headlines at the moment, 6 price record, but market calling from boiling to a simmer. Prices of properties come to the market, hit a 6th consecutive record high, like upwards trend to 369,968. This is asking price, not sold price. And that is 0.4%. Upwards trend equates to £1,334 more than the previous month. As you can see, it's going upwards, but this is definitely going from a boil, as they said it, down to a bit more of a simmer. But again, another headlines that RightMove are talking about, they're saying that RightMove revised the full year 2022 housing price forecast up from 5% to 7%. So at the start of the year, they thought we'd have a 5% growth. Even with everything that's going on in the market at the moment, they're still predicting it's going to go up even more at 7%. So yeah, it seems to be defying odds at the moment and gravity. One of the reasons is the demand of move. They're saying the demand of people wanting to move is coming down, but it's still high. So it's going from a boil down to a bit of a simmer. So it's still warm. It's not cooled off by no means yet. But let's have a look at some of the regional trends. This is quite interesting. When you look at this regional trend, we can see, look, Scotland has had a decline, the East Midlands have had a decline, the Wales have had a decline, and the South West have had a decline, like very minor, minus 0.7, 0.4, 0.6. Wales is the biggest one, 2.9, but there's still small slight declines moving forward, but the rest of the country has had an upwards trend still, which is pushing that on forward. But is it like this is all more signs of that slowing down and it going from that boil, as we keep on saying it, down to the simmer? And these statistics, look, if you look at the price activity trends on these statistics up here at the top here, look, you can see it's flattening out. Instead of going up in an upward trend, the monthly change in average asking price, you can see it's just dropping. You can see the 5-year asking price trend, again, it's just plateauing. All these ones are starting to plateau off. Again, if we have a look at property data as well, another great platform, I'll put a link in for property data below. If you don't use it already as a tool for your property investing, you definitely want to use this to analyze areas. But this will show you a little bit around some of the longer term trends in different areas. So you always want to get your information from multiple platforms. The one good thing about property data is that it grabs information from Zoopla, from RightMove, from Land Registry, all these different places, and puts it in one place for you. It's an algorithm, so some things are a little bit dated, some things get lost across these algorithms, but it's the most comprehensive one I've come across so far. So I really encourage you to have a look at that. You get a free trial. I'll give you a link for a free 2-week trial. It is £14 a month, or depending on how much you use it, but you can find off market deals. You can do loads with this. But look at the average price heading towards 300k. But you look at these different different regions and the different changes as well in there. So by region, you can see London still very much at the bottom, and even the northeast, my area, above London. It's bonkers. But again, it's that price per earnings ratio. I'm not going to go too much on about that because I've done previous videos about that. But that price per earnings ratio is that massive factor on that. But if we have a look here as well, the average price in London, you can just see that plateau. Have a look at this in the southeast. The southeast had a bit of a rally upwards. And that's based on the exodus of London and the race for space. But again, look, as that's pushing towards 400k, if you look where London is, pushing just above 500k, if it becomes more expensive to live outside of London than it does inside London, people will start wanting to go back to London. You're seeing people coming back to London as London's opening back up now anyway. Let's have a look at these other regions as well. You've got, look, the southwest. Really strong growth. You've got, and these are longer from the last crash as well. You can see the Midlands, both sides of the Midlands there. You've got prices in the east of England, and again had a little bit more of a rally upwards, but again a little bit more plateaued. The south stuff is not performed like the north. Yorkshire and Humber, massive rally upwards. The northeast, look, you can see that stayed pretty flattish for a long while, but in the last few years, the infrastructure's coming in. Obviously, all the conditions from COVID, that's had a massive rally upwards as well. And the northwest has been just on fire since 2014. That time is 15. That's when the Paris or the North deal got introduced, and it went to Manchester first. This is a change in space of that. I've done a video on this as well here, more about this shift of wealth. There's a massive shift of, if you can see, a shifting from London to other areas, and a massive opportunity in this. I've done a video, as I said, on this, so check that video out if you want to go deeper on that. But make sure you take this opportunity. In my opinion, BRR, single let properties, we might have 3, 5, maybe 10 years if we're lucky, but how we know them, you can't do BRRs in London anymore. You can't do BRRs in the majority of the south anymore. There's these other areas you can, and tech is enabling us to be able to do that from anywhere. That's what I am, Harvey, the remote property investor. That's what I help teach people. So if you're interested in learning a little bit around that, definitely give me a link in the comments, and we'll give you a link to a call where you can book on a call with me, and I can help you with your journey, whether you're remote investing or you're not remote investing. I just love helping people on their journey. And these techniques work for both. So what's been happening really weird in the market at the moment? Usually when prices are growing, rents are weaker. When price growth is weaker, rents are higher. But at the moment we're seeing it in both areas, rents. And this is to do with inflation. We'll talk a little bit more about the economy in a little while. But this is to do with inflation. But rents are also massively on the upward rallies. They're going up really dramatically. We're seeing some ginormous jumps in rents. So record high. So this is from Mortgage Strategies. And I put the links to these articles in the description below as well if you're interested in that. But record high June rents matched by record low voids. This is coming from Goodlord. This is a really credible software for letting agents, and it says a surge in high value student lets saw average rents and voids periods break records in July, according to Goodlord. So we're just going up with this, and let's go further into this article. It's saying, look, this took an average rent from £1,050 last month to a record £1,238 in July. The largest increases in the northwest, and again the north is there's a theme with all this, and where the prices have rocketed 44%. That is absolutely ginormous. And I said, as these prices, like the house prices are going up and the rents are going up, but the rents do not keep pace. Properties that we bought pre-pandemic for like 60k, we're now paying 90k for it. The rents pre-pandemic was like 550, and the rents are now like 625, maybe 650. But you can see the house price growth is outpacing the price of the growth of the rents, and it can only go so far. The rents and affordabilities, as we're going into this cost of living crisis, you've got to be careful. I talk about this as well, the all-weather portfolio, so make sure you watch this video about the all-weather portfolio so you can understand the different size strategies to protect you against this. But be wary of just putting rents up and people not being able to afford them, and make sure you get good downside protection in your portfolio for multiple streams. As I said, watch that video to go more in depth on how you can do that. So interest rate rises, real big move by the Bank of England. They've just announced it's going to go up from 1.25% up to 1.75%. This is the biggest jump they've done for 27 years. So that's a significant move. The main reason behind it, if you look at this BBC article, the main reason behind it is inflation, and they want to curb that. They're predicting that the inflation is going to hit 13.3% by October, maybe even 15, 16% by next year. In reality, it's probably higher than that already, but it's just the way they measure that. What does this mean for the property and mortgage market as well? Well, the average first-time buyer at the start of this year was paying just over £800 for their mortgage, and now they're actually paying over £1,000 for their mortgage. So this will slow things down. It is quite a big jump in the market as well, so it should slow the market down a little bit. We're going to talk about the Bank of England releasing the stress test in a minute, but I think it's all linked into this. But on the grand scheme of it, 1.75% is still really low historically on base rates for interest, and the interest rates are still majorly low. My buy-to-lets are not really, in a limited company, my buy-to-lets have not really been affected that much. When you're looking at like 75, 80% loan to values, the banks are still keen for the business, and they're not majorly putting up their rates at that barrier. It's mainly first-time home buyers. There was a product out just before the rate rises at 0.99%. The mortgage work had it. It was a 60 or 65% loan to value. I believe it was 60% loan to value, and you had a massive arrangement fee. But that was more of a market ploy in my opinion. But most rates, especially in a limited company, and that was in a personal name as well, by the way, that 0.99, there was a few low rates for people in their personal name that had good loan to values. But in reality, people that lend in 10% with 10% mortgages, or people on buy-to-lets at 25% deposits, and 10% deposits on their mortgage, and 90% loan to values and 75% loan to values for the buy-to-let stuff, especially in a limited company, the rates have not dramatically changed yet. Then we'll see. Now it's got another 0.5%. We'll see if they're going to majorly change. But I've been around 3.5% for the last couple of years, so it's not majorly changed. Still very competitive. The lenders are very competitive. They want the business. They don't want that to fall off, and that leads us really, really nicely into this Bank of England releasing the stress test on affordability. So now let's talk about the market in general. So the Bank of England have removed the stress test from stress testing people on their affordability. So used to, from 2014, they introduced this stress test to say to people, look, if you've got an interest rate of 3%, we want to see you can pay that 3% higher at 6%, or if you've got an interest rate of 4% at 7% and so forth. So it's stress tested, and they've just removed this. So for me, my opinion with this is they've removed this more to the point of basically giving sentiment in the market. The last thing the government want to do and the Bank of England want to do is they want to slow the housing market down, but they don't want to rock it too much. And with all the fears of inflation and interest rates going up and base rates going up and all this stuff going on, this is really making people scared. So it's having much more of an effect on people's sentiment and their attitude to the market, say if this happens, than it is actually the effect of the base rates being risen. The base rate rise and the rates are relatively still historically low and still very cheap lending. So this is psychologically affecting people much more than it is actually affecting them in their pockets. But of course it still is having a bit of an effect. So whether or not they're going to lend loosely, I don't believe they will, but only time will tell and play out on that. But let's have a little look at the economy in general. Talking about inflation, and the consumer price index in 2020 in May has dramatically shot up again. So if you can look, well, I'll go through these really, really quickly. I've done lots of other videos around this. Make sure you watch this video around interest rates. But what record highs at the moment. If you just look through these charts where these indexes are, it is just on a massive upward trend. And if we look at this here, we can just see how that's jumping up. Real-time inflation is probably higher than the 9% that they're reporting. It's probably more like 15% at the moment. You can just feel this in real time now as well when you're filling up your tank on your car, when you're going to the shops, when you're paying for your energy bills. Everything's going up, and it's set to get worse. In October, there's another massive jump up, even though BP has had record second highest first quarterly earnings in their history. Yet the government, I'm not against big companies earning good money, but the government should step in where it needs to step in. And if this cost of living is really squeezing people, the government should do something about it. Like, it's different if the BP wasn't earning money, but they're earning record amounts. So for me, I feel the government needs to be stepping in on this. I'm against when people go, the government should tax people, do this. I feel big companies should deserve big rewards, but they was earning big rewards anyway with putting this up. It just seems needless to me. And especially when you get governments pressuring landlords and putting squeezes on their taxes, on the compliance, and they let big companies like this just get away with this, which puts much more of a pressure on day-to-day living of people than landlords do. It's just bonkers in my view. Love to hear your views in the comments, but it kind of is what it is, and it's just set to get worse. So recessions, the UK is not officially in a recession. America are kind of in a recession, or they're not in a recession. I'm not sure where you go with this, but a official recession is when the GDP of a country goes down in 2 consecutive quarters. America has dipped 2 consecutive quarters, but some of the politicians are coming out and trying to defend this by saying it's only a slight dip, the labour market's strong, it's not an official recession. But on paper, it's a recession, but the government are trying to say it's not a recession, again, for sentiment. The government is saying they're going to bounce back out of this really quickly, but there's lots of other views around the headwinds we've got against us that could contradict that, and especially with this conflict going on in Europe at the moment, and also tensions raising in China and US with the Taiwan situation. So this is just going to add more and more pressure to the world economy that's overinflated at the moment, tons of money printing going out there. If America going to another war, they have to fund this by printing even more money, devaluing their dollar even more, and this has an effect to the whole world. So I'm talking about America here because America has the reserve currency which everybody trades in, but there's already talks of there is the G7 and there is the I can't remember another name of the other group of the rest of the superpowers, and they're already talking of getting another currency to trade in instead of the outside of the dollars. Even America are talking about potentially having 2 reserve currencies, which is bonkers. They're just trying to hang on to their status, which they're massively losing. Watch Ray Dalio's How the Economic Cycle Works and the World Changing Order. You'll get good understanding of the rising superpowers and declining ones. I'll put a link to that video below. But one of the reasons there's so much confidence, we're at record low unemployment, and there's a strong demand in the labour market at the moment for this, even in the UK and in America. So this is what's breeding a lot more confidence. But what you've got to look at is big techs are starting to lay off at the moment because of the cost. Like the cost of inflation is going to hit all companies. Energy bills, like I've seen people's energy bills go from 10 grand a year all the way up to sort of like 40 grand a year in shops and things like that. And that's going to have to be factored in and passed on. As it gets passed on and everybody else is being squeezed, that is going to make a squeeze. Companies might start thinking about layoffs. Big techs are already thinking about this in the US, so this could filter out. But it is in a knife point. Nobody knows for certain. But the one thing I will say is, let's get into my sort of predictions and where we're going with this is nobody can time the market, me, you or anybody. What you can do is look at the patterns in the market. You can start anticipating certain things and you can steady yourself to ride out different factors that could go on. But there's so many outside forces. Look, if Russia start letting off nukes, it changes loads of things in the market. If China starts letting off some missiles tomorrow or next week, and America start battling them, it changes things in the market. There's so many outside forces we don't know what's going to happen. The Bank of England, the central banks in America, if they print more money, if they decide not to print more money, if they decide to put the interest rate up load or they drop it, there's loads of outside factors we can't align for. So what we need to be doing is building our future in with what's in our controls and making our decisions based on good property foundational decisions, not based on what markets can do. As I said, there's a video that you can watch to help you make these decisions. But my prediction is I feel it's going to keep on cooling. I feel we're going to hit a headwind, that we're hitting more and more headwinds, but as a result, we're getting more opportunity. We'll see more opportunity in the markets at the moment. We're definitely translating through exactly what RightMove was saying. It is a boil going down to a simmer, so it's still hot. When you're simmering, you're still hot, but it is creating more and more opportunity. But all this uncertainty also is creating a ton more opportunity. So what I suggest you do is make sure you buy solid properties. Make sure you analyse them well. If you want a really good tool and software to analyse them well, check out Landlord. I put the link in the description for Landlord. This will help you analyse deals, analyse areas, analyse predictions. Use your numbers. The past is not always a direct indicator of the future, but it helps us measure the future and start understanding these patterns. So make sure you use the right tools. Use property data. Use Landlord. Make sure you go over the videos. Make sure you keep yourself educated, up to date. Make sure you invest in yourself. You are your #1 asset, and make sure you keep on moving forward. Do not sit on your hands waiting for circumstances to change. Warren Buffett says this: he's never made an investment decision based on what he thinks the market's going to do. He makes them on foundational fundamentals behind the investment he's investing in. So make sure you build up a good foundation of properties in a device portfolio that's going to help you drive through the market. As I said, we've got a video, it's be in the links below. All the suggestions of the links below, all the suggestions I've given on videos are going to be in the links below. But listen, my mission is to live on my own terms. My why is to live on my own terms. My mission is to help as many people live on their terms using financial education, property, mindset as a vehicle to do that. So please help me out with this mission by sharing this. Please subscribe if you've not already done that. Hit that bell icon for the algorithms of the YouTube gods. And a massive thank you to everybody. We're just tippled over the amount of being a YouTube partner. So I really want to thank everybody that's supporting me, that follows me, that keeps on watching these videos. It really makes them possible. Put any suggestions if you want below for any future videos that you want me to discuss. But remember, if you don't evolve your ideas, you're never going to live on your own terms. So evolve your ideas, live on your own terms. Have an amazing day.